Hi, you're watching BloombergQuint. Now, as investors flee to safety, emerging markets like India have witnessed heavy outflows in the wake of this coronavirus crisis. To talk about global economies and global fund flows now and after the crisis has passed, I'm joined by Krishna Memani. He served as Vice Chairman of Investments at Invesco. Mr. Memani, thank you very much for joining us. I do hope you're in good health, and thank you for finding the time to speak to BloombergQuint.
Yeah, thank you. So far, so good on the health front. We shall see.
I'm glad to hear that, sir. Let me start, Mr. Memani, by asking you how you view the impact of this virus crisis across the global economy and the response of governments and central banks to it.
So, as far as the state of the economy is concerned, it's extraordinarily dire. Probably hasn't been in this shape in a long time, at least for the short term. This is a global sudden stop. We'll be lucky if we come out of it with, just low double-digit type contractions in the second quarter, and hopefully we come out of it. But it's too early to tell as to how all of this will work out.
The fiscal responses that you've seen from countries like the US, which have now approved direct transfers of cash, or even countries in the European Union, as well as in the eastern side of the world, do you think these are sufficient? And when combined with the central bank responses to keep liquidity going, to be able to buy a wider set of assets, do you think this will help, and to what extent?
So the response from policymakers, both monetary and fiscal, so far has been extraordinary. Even during the financial crisis, it took the Fed a long time, almost a year, to get to this point. They actually, in this go around, they got to it over a weekend. So everyone recognizes the gravity of the situation, and everyone recognizes the fact that if they are not supporting the economy, the consequences for the global economy is going to be extraordinarily bad. So people are acting in good faith. People are acting appropriately. Whether the response so far will be enough, again, remains to be seen. For us to kind of figure out what the outlook will look like on the when we come out of this, we have to have a good handle on what the level of spread of the virus is going to be and how long we are going to be in this situation. Right now, we just don't have any handle on that. Having said that, I think the commitment from policymakers couldn't be any stronger. So if there is a silver lining in all of this, it is that everyone is on the case, and hopefully, if men can help the situation in the global economy, then I think there is a reason to have hope.
Are there any tools that as yet have not been used either by governments or by central banks that you think ought to be used at this point in time to help ameliorate the impact of this virus on economies, on the real economy?
So I think from an economic policy making standpoint, a lot has been unfurled for sure. But if this continues for some period of time, and today it doesn't look like it won't. So I think there'll be more that they will have to do, and more would be in terms of effectively doing a lot on the monetary front, and at least from a liquidity provision standpoint, even more than what they have done so far, and on the fiscal front. So $2 trillion, which is 10% of GDP, seems like a lot, and it is a lot. But if this continues for 3, 4, 5 months, then it won't be enough. So I think it's the same set of tools, but the magnitude will have to increase substantially, and would have to be on a coordinated global basis. I think that's the next step of policymaking.
Mr. Memani, we've seen a large volume of foreign investment outflow from emerging economies like India, not unusual at all given the circumstances and the flight to safety. What do you make of what the impact of this will be on countries like India? And I do want to talk a little bit later about how you view India's response to this current crisis.
So the outlook for emerging markets, as we have found out, and we found that out in the global financial crisis as well, that this is a global flow story far more than anything else. That is, investments that go into emerging markets, at least in the equity market, are basically flows that come out of U.S. domestic markets or other other developed country markets. Uh, and as long as the situation in those markets is not good, as is the case in the U.S., we are down 4% today. The likelihood that these flows resume for more risky and perhaps higher returns in the long term, but definitely things where things are far more uncertain, like India, I think that's just not going to happen. I think for these flows to resume, we probably have to see some sort of a bottom in the U.S. markets or other Western markets before you can expect those flows to resume.
How are you assessing India's response to this crisis, both from a monetary policy point of view, as well as from the initial moves made on the fiscal front?
Well, so I think a 3-week lockdown in India, I think from a growth perspective, is extraordinarily impactful. The positive thing that India had going in, that it still, despite growth slowing down substantially, it probably had a 6% type growth rate for the year without the impact of the virus. So that certainly helps, and the government has come down, and the first priority, of course, has to be containing the virus, because given 1.3 billion people, if things get bad, then they can get bad really quickly. So I think the government of India has done the right thing, perhaps slightly later than they should have, but they have done the right thing, and I expect, while they may be saying otherwise, that it may actually get extended, and it may actually make sense for it to be extended. So the impact of the virus is going to be substantial, somewhat moderated by the underlying trend growth rate. What they have done, both on the fiscal and monetary side, I think relative to what the rest of the world has done, is, I would say, on the light side rather than overwhelming. So this may be, again, the initial gambit, and they will, if this lasts longer than April 15th, I think they will have to do a whole hell of a lot more than what they have done so far. The constraining factor on that side is the fiscal deficit is high to begin with, but I think if push comes to shove, that would be a consideration for later, and the government will probably spend more money to kind of soften the blow than they have done so far.
So you are, as let's say, a global investor, in favor of India, substantially expanding its fiscal balance sheet at this point in time, its fiscal deficit at this point in time, if that's what's needed to fight the impact of this virus on the real economy.
Yes, so the challenge for India on that front is if they go overboard, the currency can depreciate. But at the same time, recognize that oil prices are at 20, which is the largest tab that India has. So I think the timing of all of that may be really bad for the U.S. shale producers, but for India, that is a very good outcome. So if oil prices remain where they are, and given the demand level that we will see on a global basis, it's kind of difficult to see how it gets meaningfully higher. I think the impact of fiscal deficit is going to be a little less than it would have been otherwise. But the fact of the matter is that the government really does not have any choice. If the economy needs to be sustained and we don't want social unrest, worrying about and maintaining political order, worrying about fiscal deficit is really not that high a priority at the moment. And I think global investors recognize that, and they will act accordingly.
Mr. Memani, is it possible at all at this point in time to look out maybe 1 or 2 or 3 months down the line and try and figure out or understand what a potential recovery might look like?
Yeah, so as investors, we always have to figure that out. Let's assume for a second that the U.S. spread, at the apex of the U.S. spread gets here by end of April, and slowly but surely we start reopening the economy. Expecting it to be a V-shaped V-shaped recovery, I think, is somewhat unrealistic. Even if until we find a vaccine or a cure, the likelihood that people will get on planes the same way that they used to before is pretty small. And I think savings rate in the U.S., even if people start going back to work, is going to go up as well. So I think the growth trajectory is more likely to be U-shaped than a V-shaped recovery. So the earliest I would expect things to at least get anywhere close to normal would probably be the fourth quarter. And I think there's good reason to even doubt that.
And do you expect this to be a multi-speed recovery across the world? Like, for instance, countries like India will recover at a different pace and a different timeline than, let's say, a country like the US?
Yes, I mean, to some extent, if the spread of virus in India is as low as it is today, and again, we can talk about the testing and things like that, but if India somehow comes out of it with a significantly lower spread for all sorts of reasons, I think the recovery in India can be a V-shaped recovery. In the US, with the debt load that we already have, and the trend growth rate, which was 2% going in, given all that has happened, is probably down to 1%. That's a very, that's a very kind of you where the base is getting extended kind of a recovery. It doesn't have to be that way in countries where the trend growth rate, with the right policy mix, can actually the growth rate can recover much quicker.
Okay. Many experts have tried to distinguish this virus crisis. It is unique in itself, but also distinguish it from what happened, let's say, with the global financial crisis in 2008. Given that this is impacting not necessarily the financial system as much as it is real economies, thanks to the shutdowns or the other restrictions that have been placed on people, movements, etc. Of course, part of the response is from the financial system and liquidity, but when you choose to distinguish this from the GFC or any previous financial crisis you would have seen, how do you think some of the hidden risks will show up? Do you think that there are other issues right now that we can't see, but that will implode as the economic impact of this virus exacerbates?
So there are good reasons. There are good reasons to worry on that front. So let's talk about a few things. Trend growth rate at the end of the financial crisis was probably close to 3% in the US. Now it was 2%, probably going lower. Policy rates were significantly higher. They are at zero right now, probably remain at zero. And the fiscal situation, even in countries like the US and looking more even in Europe and Japan, the fiscal situation is going to be even more dire relative to where we were in the financial crisis. So while everyone is committed to doing whatever they can, the options that they have are significantly fewer than they had in the global financial crisis. So I think if the overall global trend growth rate was going to be, let's say, 3.5%, 4%, the likelihood that it stays at that level coming out of it is pretty small. So on a global basis, things are really not looking that good. The positives for countries like India is the fact that if somehow they come out of it with their trend growth rate intact, the growth differential between developed markets and developing markets like India is going to be significantly higher than what it was coming out of the global financial crisis. So if there is a silver lining from an Indian growth perspective and from Indian markets perspective, I would say that is what we should be hoping for.
And final question, do you see hidden pockets of risk that maybe policymakers have not yet acknowledged? I'm a little curious about how you're viewing the mounting corporate debt pile that we've seen build up over the last decade, or how you're viewing some of the private equity exposures that have built up over the last decade, or maybe other things that I haven't noticed but that are on your list of exposures or vulnerabilities that policymakers have not yet acknowledged or addressed.
Well, so in the U.S., for example, they have, while they have thrown a great deal of money at the problem, they have critically not supported the CMBS, the commercial mortgage-backed securities market, for example, or the private credit market, or the junk bond market. So, and those markets grew a lot over the last few years. But in the context of the overall debt levels and architecture in the U.S., those are relatively small markets. So, a trillion may seem like a lot, but a trillion relative to 16 trillion of corporate debt, and 10 of that probably out of the high grade market, is really not that significant. So yes, there are pockets of excesses. I don't think they will bail everything out because they probably want a little bit of cleansing taking place, not wholesale, but a little bit of cleansing for sure. And therefore, they will do things on the larger markets rather than every market. Having said that, I think if you think about in a global context, the largest hidden risk is really the dollarization of the global markets. And the fact that the shortage of dollar is as acute today, is actually probably more acute today than it was in the coming out of the financial crisis. I think that's something to worry about a great deal. So far, the Fed has found a way of managing it by doing, providing repo financing and doing dollar swap lines and things like that. But at some point, the risk of one of those things breaking, where the Fed incurs a significant loss because one of the central banks that it lent some money to cannot repay, there'll be issues. There'll be issues. And I think the political reaction to something like that is probably not going to be good. So I worry about a lot of things. I worry about the fact that dollar is more of a global currency today than it was even in the financial crisis. And that's something that's the burden that the Fed carries, and there are a whole lot of risk associated with that.
Sorry, I wanted to put one more risk to you, and that is, I know it's a good thing for countries like India that we're seeing oil at $20, but that's a huge dislocation for a very large commodity market, and we're yet to see the full impact of that. U.S. shale is one angle, but the impact of that on many African economies, the impact on that on the Middle Eastern economy. I'm not even getting into the geopolitics of this. Is that again something that you think we haven't fully been able to understand yet, or play out, or see play out yet?
Oh, absolutely, absolutely. I think the shale producers are definitely going to get impacted. Maybe that's what the OPEC countries were looking to do, but in the process, they have probably heard a lot of commodity-oriented emerging markets just as much. I mean, if you look at Mexico, or if you look at Brazil, or Russia for that matter, despite their assertions, I think the impact of a $20 oil for emerging markets is going to be really substantial. And I don't think we have fully flushed it out, because we are far more worried about what's going to happen in countries like the U.S. and places like Europe far more, because these are much larger countries and economies. So, yeah, I think all of that will become apparent, and we may actually see some sovereign debt crisis coming out of it. The good thing for India in that regard is that it is more of an internal economy, or the exports are certainly important, but it's really investments and consumption within the country that matters, and it may be sheltered a little bit. But you cannot take away the global context of a potential significant emerging market disruption.
Yeah, one final question on India, Mr. Memani. We've just seen, in an effort to include Indian sovereign bonds on global bond indices, the Reserve Bank of India open up, I think, investment into some of these more liquid bond series. And now they haven't substantively changed the foreign investment limit, but what they are doing is inviting more foreign investment into sovereign bonds. Is that something that you think the world will read as encouraging at this point in time?
Well, so importing capital is going to be important for every country, especially a capital deficient country like India. So I think any policy, I think if you think about it, India got down the path of liberalization significantly when it faced its last significant crisis of a different kind and different magnitude, but in the early 90s. So if they take this opportunity to liberalize their markets more so than they have in the past, and I'm not sure if that's possible given the political situation in the country, if they do that, I think foreign investors would look at it far more positively than they would have otherwise.
Mr. Memani, it's always a pleasure speaking with you. Thank you so much for your time and your insights here on BloombergQuint. And our best wishes to you to stay well through this crazy period of time.
Yeah, thank you. And same to you and your family as well.
According to a recent report, women today contribute nearly 74% of real estate buying decisions. This includes 32% of single women buyers across the top 8 cities. And finally, women are not just buying homes to live in, they're also investing in real estate.
I think real estate definitely is the step above jewelry.
So it's my personal endeavor that Puravankara and Provident are the first choice or the first place women home buyers come to buy a home.